Right now, there's a single location on earth that can move oil prices, gold prices, inflation, and stock markets almost overnight. And it's only 21 miles wide. If shipping through this corridor stops, 1/5 of the world oil supply could be disrupted. Gas prices rise, inflation moves, markets reprice risks, and capital begins moving across the global economy. Most people will only notice the headlines after it happens, but investors watch something different. They watch the system behind the headline. Because when global tensions rise, the missiles themselves don't move the global economy. Energy does. And when energy supplies become uncertain, it triggers a chain reaction through inflation, interest rates, currencies, and financial markets. Today, we're going to break down the chain reaction. War, energy, inflation, and the movement of capital. Let's follow the one. When geopolitical tensions rise, the media focuses on the conflict itself. But financial markets focus on something else entirely. Energy. Because energy is not just another commodity. Energy powers the entire global economy, transportation, manufacturing, agriculture, shipping, electricity, and every one of those systems depends on energy. And when energy becomes more expensive, every one of those systems becomes more expensive to operate. Fuel costs rise, shipping rates increase, airline margins shrink, manufacturing costs climb, food prices begin rising, and suddenly inflation spreads through the entire economy. History shows this pattern repeatedly. The oil shocks of the 1970s triggered global inflation. Energy disruptions during conflicts in the Middle East pushed commodity prices higher. And every time inflation accelerates, central banks face difficult choices. Raise interest rates to control inflation, or support economic growth by keeping money cheap. Those decisions shape the entire financial system because interest rates affect everything. Mortgage costs, business investments, stock valuations, currency strengths, all of it connects back to the inflation environment, and energy sits at the center of that chain reaction. The global economy depends on a handful of strategic locations where massive amounts of energy pass through narrow geographic corridors. These are called energy choke points. And they are some of the most important locations in the global economy. The most well-known is the Strait of Hormuz. This narrow passage connects the Persian Gulf to the open oceans. And roughly 1/5 of the world's oil supply moves through this corridor every single day. If shipping through this passage is disrupted, even temporarily, energy markets respond almost immediately. But the Strait of Hormuz is not the only choke point that matters. There are several others that play vital roles in global trade. The Suez Canal connecting Europe and Asia. The Panama Canal connecting the Atlantic Ocean and the Pacific trade routes. When disruption occurred at these locations, global shipping slows. Energy supplies become uncertain and markets begin adjusting for the risk. When energy prices spike, the economic consequences move quickly. Oil becomes more expensive. Fuel prices rise, shipping costs increase, and companies begin passing those costs on to the consumer. And inflation begins spreading through the system. History shows this pattern repeatedly. Energy shocks lead to inflation cycles. Inflation cycles lead to central banks' reactions. And central bank reactions move financial markets. And this is where investors begin watching something very closely: real assets. Because during inflation cycles, capital often rotates towards assets that historically protect purchasing power: gold and silver. And precious metals have historically acted as a financial shock absorber during periods of uncertainty. When currencies weaken or inflation rises, investors always seek store value assets that can't be printed by central banks. During geopolitical shocks, capital rarely disappears. It simply moves. Energy producers benefit when oil prices rise. Defense contractors benefit when government increase military spending. Commodity markets become more volatile when supply chains tighten, and precious metals attract investors seeking stability during uncertainty. Gold, silver. But something else happens during these moments. Currencies move because energy markets are deeply connected to the global currency flows. Oil is largely priced in US dollars, which means changes in energy markets can influence the demand for the US dollar itself. And this creates a complex system where multiple markets adjust simultaneously. Energy, commodity, currencies, interest rates, equities, all responding to the same underlying forces. So when geopolitical tensions rise, markets began evaluating three possible outcomes. Scenario 1, rapid stabilization. Tensions cool quickly. Energy supplies remain stable. Markets experience short-term volatility, but recover as uncertainty fades. Scenario 2, you get a prolonged disruption. Energy prices remain elevated for months. Inflation pressure persists, and central banks delay rate cuts. Markets become more volatile, expectations adjust. And scenario 3 is a major escalation. Energy supply disruptions becomes totally severe. Oil prices surge dramatically. Inflation accelerates globally. And the financial system undergoes a major repricing. Markets constantly evaluate these possibilities, adjusting prices as new information emerges. So if you want to understand how these events unfold, there are three signals investors watch closely. First, energy prices. If oil price spikes briefly and stabilizes, the shock may remain temporarily. Inflation expectations. If markets begin pricing higher long-term inflation, the central banks may be forced to react. Third, interest rates. Bond markets quickly reflect changing expectations about inflation and growth. These signals often tell investors more about the trajectory of the global economy than the headlines themselves. Because the biggest shifts in wealth rarely happens overnight. They unfold through systems, energy systems, monetary systems, trade systems, and the investor who learns to read those systems are the ones who see where the money is moving before everyone else does. If you missed episode 6, where we broke down how AI is reshaping global power and critical infrastructure, go back and watch that video. It connects directly to what we covered today. If this episode gave you clarity, like the video, subscribe. If you're serious about understanding macro shifts, and share this with someone who needs to think ahead and not react. The global system is changing. Energy, technology, money. But in the people who understand those forces early are the ones who position themselves before the next shift unfolds. I'll see you in episode 8. And until then, keep watching the signals and keep following the money.